Assalamu alaikum wa rahmatullahi wa barakatuh. So today, this is 9th of February 2026. My name is Muhammad Hanzala, and I will be talking to you about Focus Point, a company in Malaysia listed in the Bursa, which is the stock exchange of Malaysia. The title is Eyewear Retailer with Interesting Investment Prospects. This is investment thesis and valuation. This is a bit of the cautionary statements as someone providing a little bit of information. I am not a licensed advisor. So do read this before you take anything from the video. Okay, so the business overview of Focus Point is that it is recognized as the largest retailer in Malaysia that provides eyewear solutions with over 200 outlets nationwide. It started back in 1989 with the founder Dato Liao Chun Liang as CEO and founder. So he is currently the CEO. So this is a founder-led business, meaning the business is still run by the founder. The founder found back in Johor, 1989, and currently they also have a food and beverage segment, which makes around 15% of revenue. This is in the fiscal year 2024. So this is another part of their business. This is the outlet. So the outlet pertaining to the eyewear, optical retail outlets. So you can see the growth here. And this is the outlet overall. So they have many different brands under their or subsidiaries or outlet, you can say, outlet brands. So on the right, you can see the different amount of outlets with the different outlet brands, as you can see. You can see Whoosh, you can see Opulence, you can see iFont, different, and they normally target different kind of users. Like Whoosh would target the more budget conscious users. And then you can see how much is wholly owned and how much is a franchise, because they have a franchise system with their retailers, with their retail outlets. Now we move to the investment thesis. So it's not super deep, but it's an interesting prospect in terms of, firstly, it is the largest optical retail, and we have to keep a note that retail is not an attractive business because competition is very heavy and there's no barriers to entry. It's very thin. So the only redeeming factor about Focus Point is that it has a large uh, outlet network in Malaysia in a fragmented market, which amounts to 7% market share of the retail of eyewear. Again, this is it's not necessarily an attractive point because scale on its own is not a meaningful moat. You can economic moat because you can be smaller with a actual economic moat. Retail is a weak economic moat, but we should proceed to the other thesis. This is just to note that it is the largest, and it is the second place in the market is still half the size of a Focus Point when taking into consideration the number of outlets. So the second player is A Look, with the third player being a Chinese brand called MOG. So when we go to the second thesis, it's about the free cash flow. So we have 20% free cash flow, which means that if the valuation of the company is very low, which results in that if Focus Point maintains their free cash flow at a 0% growth rate, you as a shareholder will get your capital back, your principal back on the fifth year. So usually free cash flow yields would be around 3%, right? But for this 20%, it's a very attractive prospects and very attractive potential returns, obviously. Then we move to the third point: advantages over other of retailers. This is of the types of retailers because of the rise of e-commerce. If you have noticed, a lot of company has gone bankrupt or almost become obsolete due to e-commerce. With the rise of e-commerce, and I believe that e-commerce have this kind of effect on people with their instant gratification in the sense that the more you purchase online, the more you will get used to the e-commerce, and the more you feel that urge to purchase something online because of that dopamine hit or something that you get your product instantly through just a click of a button. So this is a trend to stay, meaning that people will most probably, in my opinion, will purchase more stuff online, and this is a trend. But the thing is, when it comes to eyewear, it's a little bit more resistant with people shifting their purchase to online. Obviously, the higher cost and stuff deters people to buy it offline. I mean, yeah, online. And there is a company in the US that tried to provide their service fully on e-commerce, but actually failed. They tried to give samples of four glasses or five. I'm not too sure, but around that number of glasses, where the customer would try it on and then they would send it back to the outlet to see if they like it or not, and then they get their glasses. So it's basically you try it back at your home, and this failed, and which led them to having and being necessary for them to open outlets. So we believe that e-commerce will erode the market for retail, but it will erode at a lower pace. So it's not necessarily a company that you want to keep in your portfolio forever, and it's like a compounding machine, but it's more of a value play. That's my opinion on it. And we have the next investment thesis is that we have large management holding by by the CEO, which was mentioned earlier, the founder. He has around 38%, which it holds more weight in terms of management's accountability, because now whatever the CEO do and the founder manages to perform, it will reflect back at his own wealth. And then we have potential growth in smart glasses. Of course, they are now partner with Solos, and it's not the best in my opinion. It's not the best smart glasses, but if we see the rise of meta glasses and the rise of this innovation, and that they get from suppliers glasses that they can sell to us as consumers, then we can see that potential growth additional to their normal growth. So if we see smart glasses, so that's a speculative one, but nonetheless. And lastly, we have structural growth from lifestyle shifts and genetic prevalence of myopia within Malaysia. So with what I mean by lifestyle shifts is that the more we look at close objects, even reading books, doesn't matter if it's a screen or not, but the more we look at close objects, and the more we are away from sunlight. So these are the two factors which I have read that affects people's eyesight in terms of symptoms, not symptoms, but rather what lead or what causes myopia. So if you can see, just genetically, Chinese people are more myopic, or they have a more they're more prevalent to gaining myopia. And then to the other extreme, the one that is least, or the ethnicity that has least um, prevalence for myopia, is African people. And we can speculate that this is because of their outdoor nature. They're more outdoors, and they do more activities which involve not just looking into near objects. So these also increase. I mean, this is the genetic prevalence. So in Malaysia, we are consisting mostly of people who are Chinese, and even with the ethnic group of Malaysian and the Indians and other foreigners. It's we're we're quite developed in a nation to whereby a lot of things require us to do close monitoring, or we are looking at objects close to our eyes, which affects myopia and increases the prevalence. And also, we tend to stay more and avoid sunlight because of the current model of our jobs, right? The job scope and stuff. And now we move to valuation. So this is the second part of the whole presentation. So we have three factors of focus points growth rate. Initially, or firstly, we can say that increase in myopia prevalence within Malaysia. So this is coming from a research article, and we estimated for Malaysia that it could be around 2%. So this means every year the prevalence within the population of Malaysia will increase by 2%. Then the second factor is Malaysia's population growth, so around 1.25%, which also affects, obviously affects the demand for eyewear. And then third, which is the price increase of products. I will show you in the next slide what is how do they increase the product prices. Obviously, they indexed, or no, they inflation adjusted or something, but they can have that power to increase the price to sell to the end user. So then the total estimated growth rate is around 6.25. This is what we estimated. So going at, we have one example, but there are many examples. I just want to simplify with just one example. So this is on their whoosh glasses, same specifications, meaning that they're the same item here. One is the listing in 2023, and one is in 2025. So we use the Wayback Machine. If you don't know, this is a way for you to go back to see website in the previous years. So in this case, I saw that Focus Point in 2023 selling the glasses at 198. So I'm taking the base price, not the discounted price, because that will shift everything. Taking the base price. So if you see under the cross of the 2023 pricing, it's 198 ringgit. And then you see the 2025, 218. So this price increase of 10% over 2 years. So this computes to a 4.93% CAGR, or compounded annual growth rate, the price increase that they can afford. So if you look back at the last slide, we assume that overall, okay, they can increase the price by 3%. For this specific glasses, they could increase for 4.93%. And then there's other product lines like their contact lenses and stuff. And I take the average with a bit of conservatism, and round it down to 3%. Okay, so the dividend policy is that they have to pay out at least 30% of audited consolidated profit after taxation. So yeah, now this is basically the dividend policy. And then for the valuation on the dividends, we want to see the growth rate. So here I'm using fiscal.ai for checking the growth rate. So over 6 years till 2024, we didn't take 2025 because it's not a full quarter. Although it doesn't really matter because, yeah, it won't really matter too much because the dividends are paid semi-annually, meaning they're paid twice in a year. But nevertheless, we take the 16.2 million, which is the dividends paid in 2024, and compare it to the dividends paid in 2018, which is around 1.7 million. So this This computes to a growth of 45.6% annually in the growth of the dividends. Do we expect it to grow like this in the foreseeable future? We don't believe so because of the next slide. And of course, yeah, we don't believe it's sustainable due to the payout ratio. So we go to the next slide. We see the current payout ratio estimated by fiscal.ai is 62.8%. So if we assume, okay, this is a very conservative assumption. If we assume that margins stabilize, and that means what that means is it's growing at 0%. So it's neither losing in margins or increasing in margins. So operating and net income margins. Um, and we assume that revenue growth is 6.25%, which means that dividends, if they can basically pay out the same amount ratio, they will pay increasing the dividends 6.25 per year. This also assumes that the free cash flow conversion rate remains the same, and that the margins with the net income margin also remains the same. So this means that the payout ratio will remain at 62.8%. Now the valuation. So the actual valuation here. So just not to make it confusing, we look at the dividend section on the top, the third row after the year. So we see that it grows at a percentage as mentioned earlier, the structural growth, right? 6.25, which if you see below it, you see that dividend growth rate G is equal to 6.25%. So with the calculation, and we assume that the terminal growth rate for the dividends, so basically any dividends after the 10th year or after 2035, we assume that the growth rate will be 1.5%. And now this could be a bit more conservative by assuming that you don't get dividends past the 10th year. But we just assume after the 10th year, they will grow their dividends by 1.5%. So this overall computes, because the market price today for Focus Point, if you see the section with current price, it's 0.49 ringgit for one share. And with the computed valuation that here, a very conservative estimate, we can see that intrinsic value is 0.69 ringgit, which computes to a potential upside of 40.5% to today's market price. However, if we look at the CAGR return, that means over the 10 years, what is your expected compounded annual growth rate in your shareholder returns? We can see around 11.42%, which is attractive. And this is with assuming that the bare minimum in terms of dividend growth rate, right? And now we move to a more it's less conservative in terms of growth rate. So the only thing that changes in the next slide is that we have a growth rate. If you check lower to the bottom of your screen, dividend growth rate G, we assume 10%. This means that dividend will grow every year by 10%. So this changes the speed or the amount of dividends that you compound. The terminal value is also set at 1.5%. So this computes to a intrinsic value of 0.91 ringgit, which is a potential upside of 85.6%. So this is more attractive, of course, way more attractive. And if you check just beside it, it says the CAGR returns. So meaning that the 10-year return period you can get per annum or the compounded annual growth rate of your shareholder return is 14.75, which is around 15%, which is very good because that means you can double your money around 5 years. Of course, what does this mean? If you look back at the last valuation, if we assume that the payout ratio is 50% for the current year, The 10th year will have also a payout ratio of 50% because the growth of the dividends is the same as the growth of their net income or their EPS. But in our next assumption, because our growth in the dividends is faster at 10% instead of 6.25, so the growth of the dividends is 10% and the growth of EPS is 0 or 6.25%, we can see that the growth of dividends is faster. So what this means is that over time, the payout ratio will increase. So if you look at the right side under the red text, EPS at 2025 is 0.052 ringgit. Okay, this computes to a payout ratio in 2025 of 53.8%, which is modest. This differ from fiscal.ai, which they estimate around 62.8%. But nevertheless, I mean, even if you take 62.8%, it's almost around the same number. But the calculation I managed to find the actual calculation is around 53.8%. This is the payout ratio in 2025. And now we assume the EPS growth rate is 6.25, the structural growth rate that we've been using for this whole time. Except what changes now is that dividend grows at 10%. So what this does to EPS is that okay, EPS goes to 0.095 ringgit in the 10th year or in 2035. This is reasonable, as expected. Of course, a bit conservative. Of course, they can be better in the margins, they can be better in the revenue, but this is conservative. We keep it that way. And we move on to the payout ratio for 2035. This will shift a little bit because of the fastest the faster growth of dividends, which means that they have to pay more of their income or net income, right? Because their net income is not growing to the same pace as dividends. So that means that payout ratio is 76.2%, which we believe is still fair and it's still reasonable for them to have this amount of payout ratio. I mean, I believe so. So, what's what's the end? The conclusion is that we see the valuation for this focus point company, this company in Malaysia, is that it's a very it has a very high margin of safety. A lot of things can go wrong before it's actually probably not going to be a good investment. It just needs to find a it just the materialization of the price needs to be there because it can be worth a lot more and it can return you around 15% per annum, which is a very attractive shareholder return. So, with that, me and Black Swan Research, we would like to thank you for your attention and Assalamu alaikum wa rahmatullahi wa barakatuh.